A very good morning to all of you, and thank you for this warm invite for all of us to be here and talking about this very important subject on RERA, MahaRERA to be more precise. As you all know, this act got in place, got approved by both houses of the parliament last year sometime in March. Since then, it has been a progressive journey. Various states have come out with their own versions of rules to sort of substantiate what the central government had sort of ruled out, put it across, and they have gone through various stages of iteration as well, Maharashtra being one as well, where if you all remember last time somewhere around October, November, a draft set of rules had sort of come out, and subsequent to that they got finalized, and 1st of May onwards, when all the notifications of the Act were put in place, the rules or the Act actually came in full force. So since that point onwards, all ongoing projects have to get registered. You can only register and sell projects which are registered with Maharashtra RERA. And as you all know, MahaRERA is the first state which has rolled out a website as well, which allows you to register the projects online, which is a facility I can tell you is a blessing in disguise, while most of the other states are still struggling to put it in place. So a great job from that perspective. And the government has done a phenomenal job from that side. Since that time onwards, if you would notice, there have been various clarifications that have been issued by the authority, and a last set of FAQs were rolled out just last weekend, and I'm sure you must have all had a chance to go through it. If not, Mr. Chatterjee will be here subsequent to this presentation, and I'm sure he will be able to take many of your questions in place to do that. Since May 1st, we all know there is a 90-day window which has been provided by the government to to ensure that all ongoing projects which are there to be registered, the developer community can put all of them in place, get all documentation in place, upload them, get a registration number, and move on with the process of doing their business in the normal sense as they have been doing for all this while. And same applies for the real estate agents as well, who need to get registered. If we briefly look upon the Act, just to set the context right, the Act actually, the way it can be interpreted is that it has 5 foundation pillars on which this entire Act is resting upon, which forces in place financial discipline, transparency, putting in place the accountability, which has been fairly important area, customer centricity, one of the most significant aspect of the Act around which the entire rules, regulations sort of revolve around, and to ensure that there are compliances which create again a set of transparency and the level of information which is required for any customer to sort of pick up a unit or buy a unit in any of the ongoing projects. As we all know that the projects which come under the ambit of RERA fall under 2 categories, or the first 2 thresholds. First being that 500 square meters or more, or if the number of units are more than 8, there is a point of sale for any of these projects. They come under the ambit of RERA. If we broadly look at or dissect the entire Act and try and identify what specific elements are entailed when one is talking about physical discipline or any of these 5 pillars that one is talking about, let me just spend a few minutes and just take you down through that so that it helps you contextualize this entire discussion, and subsequently when my colleague Imran is going to talk about a certain areas of focus on the Act which is impacting the developers in a fairly significant manner, you will be able to relate those dots better, and subsequently when Mr. Chatterjee will sort of add on to the next phase, which is the registration phase as well. When we look at from a physical discipline perspective, as we all know that there is a provision of entailing a 70% and 30% account waiver when you register the project. So the 70% of all the collectibles go into a separate account which has to be used for the construction of the projects, and 30% is the money which is available to you. So it entails to create that physical financial discipline for all of the promoters to sort of go forward basis. The withdrawal of the amounts from each of these accounts can be done only when then you have certifications available from 3 primarily agency, one being the architect who's who's approving of the physical percentage completion of the project, the civil engineer who's certifying the cost of the project that has been incurred, and a chartered accountant which looks at the overall cost of the project. And once these three certifications are in place, that defines the amount of money that you can withdraw for the project on an ongoing basis. The project accounts which are supposed to be set out, they are required as per the authority to be audited on a yearly basis, and that certification has to be provided to the authority as well to ensure that the money that was collected from the customers has been used judiciously and has been used for the intent of the project also. There are certain provisions in the Act which are fairly stringent as well, which in case of a non-compliance with regards to any of the let's say the financial discipline related areas, the authority can even go and freeze the accounts of the developers and prohibit them to use that fund for any of the projects for that purpose. So maintaining that discipline is of prime importance. The next area focuses on transparency. As we said, that once you go onto the project website as well to upload your information on an ongoing basis, not only for the first time when you're looking at the registration, but going forward as well, it will ask you to provide all sorts of information with regards to what are the total number of units that are to be sold, what are the ones that you are proposing, what are the carpet area of those units. Carpet area now henceforth pan-India becomes a consistent definition to be included as per the Act. So buildable area, sellable area, all those definitions don't figure into the set out which has been put forward from the Act perspective. Also, what important thing from this area happens is that going forward, if there is any change that needs to happen, first of all, the Act says that you have to build everything which has been proposed as per the sanction plan. So basically, sell what has been put together in the sanction plan, you build as per what is put in the sanction plan. Any deviation that happens which gets qualified into major change, and there is a definition of major change or spell out in the Act, and if you actually read through it, it is virtually the entire universe, if I may, in a very loose term, sort of covers everything under the sun, and which will require a 2/3 consent to be taken from the allottees. There is obviously a definition of allottees, and I would not want to sort of right now just get into the details of that, but also from any other change which is minor as per the definitions of the Act, you need to inform the allottees of that. So I mean, basically stating in a way that going forward, the way of doing business is going to change. The way the designs used to sort of evolve as the project is going forward, I mean, slowly, steadily, you will see that that norm is going to change, and it is gravitating towards more of the fact that you are concluding your designs, getting the approvals in place, and building only that, because that is what is going to mitigate your risk. And any ever-changing scenarios is going to create complexities. Even the model agreement, if you look at it, it talks to the extent of defining the specifications of the product that are you going to be using. So far it was left out, just for example, say Italian marble. Now going forward, as an annexure in the model agreement, you will have to include details of what that marble is going to be. Either you provide with a specification or you give them a price range in case the specification has not been defined. So from all areas, from that side of it, it is getting fairly controlled in that manner, giving you very less flexibility to sort of move around or keep the design process fairly evolved from that side of it. Project completion timeline is a must that needs to be sort of disclosed, and you get only a waiver of at the maximum about 1 year, only if that you can also prove that those delays are not on your account, and there are absolutely, in every sense of it, documented and can be proved and taken forward from there. Accountability, the another pillar that we said that the Act is sort of resting upon, is creating, it has clauses inbuilt which says that on an ongoing basis, at least on a quarterly basis, minimum within the 7 days of completion of a quarter, all the details pertaining to the project, which includes any of the proposed or any of the approvals which were proposed earlier at the time of the registration, but now that the project has moved on and the developer has secured them, have to be disclosed that things have moved on. It has to be disclosed what is your, against the estimate that you put in place at the time of registration, against which where you are right now, the expenses that have happened, what has been your change in terms of the units that you had said were proposed, how many of them have been sold, or otherwise cancelled, all those details on an ongoing basis needs to be sort of disclosed going forward. One interesting aspect of the entire act is also that, keep in mind, it is just not promoters who get the entire focus of the act. RERA goes down to the people who are the key management personnel as well in the organization. If it can be proved that because of any of their delay, that there was or lack of action, that it caused a delay onto the project and there were consequences on it, authority can actually even take them up onto the cause. So it becomes fairly important for all to understand the roles and responsibilities of each individual within the organization and how it is sort of spelled out in their agreements within the organization as well, and when you're getting into a contractual mode as well with outside contractors, so that you can help them accountable as well. So something to be kept in mind from that perspective. Customer centricity, another important area. Advertise and sell only which is sanctioned and approved, something that you will deliver. Don't mislead the customers, don't misadvertise. Even verbal communication, SMSs, any of those things which are not in line with what you are going to be proposing can be sort of taken as a wrong step, and the authority can sort of take actions against each one of those such statements which happen in place. Compliance, as I said, on an ongoing basis, one has to update all of this information. What is the summary of all of this? The summary of all of this is the fact that while, of course, registration is an important area that, that you have to register unless going forward beyond 31st July, if the project is ongoing, you cannot make a sale, but it also that you cannot launch any new projects unless they are registered with the authority. Keeping simple things, just as a conclusion perspective, going forward, RERA becomes the new norm of doing business. It is a significant change in the way one was operating business so far versus how things are going to be moving forward right now. If you see just this diagram, RERA transcends into virtual every aspect of business, be it finance, be it design, be it contracts. Simple example, DLP. DLP has now been extended. This is the defect liability period as per the Act, has now moved on to 5 years as opposed to what people were free to include earlier or what the manufacturers were providing to be in place. I mean, just to give you an example, if you do an analysis to fix this whole issue of defect liability period and that you don't get into the cross webs of a deficient quality, it is virtually as good as about 20 touch points within an organization that you need to fix. So going forward, as I said, the impact of RERA, how it is happening or impacting every function within an organization needs to be understood in great depth. Going forward, your procedures, policies, all of that needs to be augmented to take into account that any of the areas which have been stipulated in the Act you are fully in compliance with that, because it is just not one-time registration, mind you, it is an ongoing compliance going forward that needs to be kept in place. Well, not to scare anybody out here, but I mean, as we all have read through the Acts and we have realized that there can be far-reaching consequences of non-compliances with regards to RERA. I mean, 10% of the project cost is a fairly substantial amount of money. There are other penal provisions as well, which have been sort of listed out. It is obviously becomes even more important that not only the organization, the key management professionals, but the contractors, the agreements that you get into it, all of this is like a seamless story from one end to the other, and everyone understands the consequences of if you are not in compliance, then what can happen. So from that perspective, it's a fairly stringent regime that has been sort of created. As we all know, and I just mentioned at the beginning of our conversation as well, Maharashtra being one of the first states which has rolled out a website, other states have followed. Rajasthan just released about the last week an online registration process. The window is open until 30th of July and the time is kicking. We are almost through halfway of that timeline. That becomes even more important that all of us ensure that the ongoing projects which fall under the ambit of RERA, our online registration process is completed for them. Again, as it said, it's a time-bound exercise. Mr. Chatterjee, I think in one of the previous sessions in another location just the day before, has also sort of highlighted that there is no going to be any further extension of this timeline. So that becomes an important area for all of us to focus. But do keep in mind that it is just not an administrative exercise to sort of compile all of the information and just upload it. Collation of these pieces of information, which is henceforth going forward, will become information readily available in the public domain. So any and potential risk that emerge out of the pieces of information going forward to be shared needs to be very carefully evaluated internally, and anywhere where a correction needs to be taken has to be sort of accounted for before it sort of moves on. In addition to this, there are various other considerations as well that one needs to keep in mind, one being the financial aspect of it as well. Not taking any further time on it, and I will request my colleague Imran to join me on the stage, and he will walk you through a couple of examples and some key areas that should be of interest to you from a financial management perspective as to how it is the RERA is impacting them on the projects going forward. So, Imran. Thank you.
Thank you, Ashutosh. Good afternoon, everybody. I realize we are keeping you away from your lunch, so I'll try and keep it brief. What we have tried to do here is, through the Act, there are several provisions that lay out on what needs to be done with the fund flow. What we have done is we have really broken it down into steps that can help you proceed and come to the key question on what is the maximum withdrawal limit that one can take out of the separate RERA account. The way we built it up is step one really is to define your cost, which includes your cost of the past and your projected cost. Step two really goes into defining your receivables. It's very important because 100% of your receivables, if it's falling short of project cost, the provisions are very different. The 70% retention actually moves to 100%. Hence, it's important to define how that's getting computed. All of that links into what is the maximum allowable withdrawable limit from your 70% separate account. That's the maximum amount that you can withdraw, and that can be used further for land and construction cost. And just to end that, we have a structure which says pre and post RERA, how is your fund flow going to be different on the same project. Just moving on, the calculation of the pending project cost is a mix of 2-3 components which have to be supported by several different certifications. The first key component is the balance construction cost that one needs to incur, which is where the engineer comes into the picture and his certificate would validate that cost. The other 2 components would be certified by a chartered accountant. Here is where the interest or the finance cost on land comes into the picture, and the construction loan which has been taken for funding comes into the picture. Now, when you put all of this together, you will get the pending cost that one needs to incur on the project. This is a very important computation, and one needs to be as close as one can be to reality, because these costs would then determine how your fund flow will be for the remaining part of your project. The important thing to note here is that there are certain costs that one may not be allowed to include in these costs. Certain costs like overheads cost and sales and marketing costs that one would have to view very closely to see what element of that cost can be included in your estimated costs. The next point is on receivables. Clearly that's broken down into 2 components. Your one component is what have you already sold and what have you collected of that. The balance receivables is something that's very easy to quantify. The second key component really is your unsold stock. When you look at your unsold stock, there is an X price that's available in the market, but one has to refer to the ready reckoner rate to determine what would be realized from this balance unsold units. Again, one have to bear in mind that the ready reckoner rate typically available in the market relates to the built up area. This has to be adjusted to the carpet area in terms of definition to come to what will realize more from your unsold stock. Now, when you put both of this together is your future receivables that's coming out of a project. If that amount is falling short of your yet to incur cost on the project, there are different implications that the Act lays down. For instance, if the total receivable is less than what you have to spend, 100% of whatever you receive in future will have to be parked into the separate RERA account. If it is more, obviously, then you have the flexibility of the 30/70, but it's very important that you do this computation upfront and have a comfort that whatever is future receivable is sufficient to fund your construction. That takes us into your maximum limit that one can withdraw from an account at a point in time. There are 2-3 components in this. The first element is your cost component. If the financial component of it is what the cost has already been incurred. If you take that and compare it to your total estimated cost, you will get a financial completion of your project. That is a percentage completion that a chartered accountant will certify. The second component of that is what an architect would confirm is through his certificate, which will be more of a physical progress. Now, it is important to note that whatever is the lower of the two is something that one has to consider in terms of your withdrawal limit. If financially one has incurred several costs, but physically that progress is not evident, the architect percentage completion would be lower. For example, if you have ordered or placed an order for, let's say, 200 doors, they have arrived on your site, but they have not been installed on the project, the percentage completion from a financial and an architect perspective would be very different. One has to bear in mind that the lower of the two would be taken. Hence, your project planning, your cost increment, your placement of order with contractors, and how all of that ties up to your physical progress is something that one needs to plan much more closely going forward. Because one will be taking the lower component, possibility are that before your windows and doors are installed, the vendors already at your door asking for that money. So one will have to be very careful in how that whole planning is structured going forward. Once you have that percentage completion, that has to be multiplied by the total estimated cost. That will give you the amount in value what you can withdraw from an account. It's fairly simple that way. It in other words says that from a financial perspective, whatever you have incurred, you can actually withdraw. From an architect's perspective, the percentage would be different. But in principle, as long as you have spent something on a project, that's the amount that one can withdraw. The second component to consider when you're thinking of maximum withdrawal limit is what is the balance that's available in your receivable account. Now, for a lot of ongoing projects, developers would have collected the money and would have withdrawn that money from the project. We will have to consider 70% of that collected amount as a notional amount that's available in the account, at least from a computation perspective. We have to add any additional receivables that you get from the project to come to what is the notional balance in this project account, which then takes us to the last line, which is what will be allowed for withdrawal. It is the minimum of A and B, A or B. So if you have incurred more than what you have collected, it's a very healthy position to be in. That much amount will be available for you to withdraw. However, if you have incurred less and you have collected more, that will determine your withdrawal limits. From this amount that you have computed, you will have to reduce whatever notionally you have added in terms of past collections. Now, this is a very important deduction that happens in the whole formula. For instance, let's say about 100 crores was collected from the customers in the past. 70 crores of that is something that you will have to adjust from your from this amount to come to what is allowed for withdrawal. The reason how this is structured is that while all the costs that you have incurred in the past is allowed for you to use in the computation to what equity and money has been spent on the project, at the same time the formula takes into consideration that the amount that you have actually withdrawn is something, the benefit that you have already taken, and hence has to be adjusted to come to now what's the additional amount that we can withdraw from this account. This computation will give you in value terms what you can withdraw, and this is something that you will have to do every time you want to approach for any withdrawal. Your certifications are also that's something to be done for every withdrawal. This comes to a point where you'll have to start planning your withdrawals much more in advance, because not just because of certification, also because the chartered accountant or the architect will take their own time to give these certifications. For example, a chartered accountant will need provisional accounts for you to start preparing for a CA certificate. When we look around, a lot of developers don't even make monthly accounts. So for you to withdraw 3 or 4 times in a month, you will need to have that kind of robust systems that allows you to prepare accounts which quickly can be churned out by the chartered accountants to say, this is the percentage completion that one can certify. So those are a lot of process changes that one will need to do in the background to even be able to come to terms with what can be withdrawn. While you may have spent, but if the CA certification, then the processes don't support it, there will be a time lag which one will need to start considering it upfront. That takes us into the last slide, which is saying how is this account going to operate. We've just drawn for you what was pre-RERA, and typically we found that pre-RERA there's an escrow account that sits on the 100% collection account. Typically a lender would have an escrow on this, and they would manage withdrawals. Cost statements would have to be sent to them, and they would approve of withdrawals from this account. Post-RERA, the situation changes because that lien cannot be created on the first collection account. You have to split that between a 30% and a 70% account. The 30% account is something which the financiers are looking at as the account where they will have the primary escrow. The second account, the 70% account, is a separate RERA account which has to comply with the RERA regulations before any lien can be put on that. Now there are various structures which I'm sure my banker friends will cover, but once X amount of withdrawal is permitted from the 70% account, that money, the various structures that are currently getting discussed in the market may need to move back into the 30% account so that the lien continues, or there is a separate account from which a developer can manage and plan his expenses. With that, I'll just leave it to the bankers to see how those accounts are getting structured. But that's a brief from us. Thanks a lot.